Today I am going to talk a little bit about EPS, earnings per share. Earnings per share is one of the most important variables for determining a company's share prices. A high EPS indicates that the company is more profitable and has more profits to distribute to shareholders. It is calculated on a quarterly or annual basis. Higher earnings per share is always better than a lower ratio because this means the company is more profitable and the company has more profits to distribute to its shareholders. For example, ABC and Company is a small company. This company is holding 10,000 outstanding common shares and a net income of $100,000 per year. That means its earnings per share is $10. If the company distributes all of its income to shareholders, each share receives $10, which is known as EPS, earnings per share. This can be calculated by using the formula net income minus preferred dividends, divided by end-of-period shares outstanding. If we apply this formula to ABC and Company, EPS equals $100,000 net income, minus $0 dividend divided by 10,000 common shares of the company, that is equals $10. Also, the EPS is one of the important indicator to evaluate the PE/NDSP ratio, which we will discuss in our future video.